So Fifth Third Bancorp reported a massive gap miss this morning for Q1 2026. They posted diluted EPS of just 15 cents against consensus estimates, but they actually printed a heavy adjusted EPS beat of 83 cents.
Yeah, and total revenue on a fully taxable equivalent basis hit $2.834 billion.
Right, with net interest income surging 26% sequentially, bringing it to $1.939 billion.
And the forward guidance looks incredibly aggressive, honestly. They are projecting Q2 NII to accelerate between $2.20 and $2.25 billion.
Which is why shares are trading up about 2.5% pre-market. Wall Street is clearly looking past the headline noise and just digesting the core run rate.
Absolutely.
So we are looking directly at Fifth Third's official Q1 earnings presentation today, along with the accompanying press release from April 17th. And if you are trying to analyze this newly combined bank, your primary mission for this deep dive is cutting through all the messy day one accounting distortion.
You really have to, yeah, to find the actual operational health of the bank.
Exactly, because an optically disastrous 15-cent EPS completely masks an underlying engine that is, frankly, running extremely hot right now.
It really is. The divergence between the GAAP numbers and the adjusted reality here is entirely a function of M&A accounting mechanics.
Right.
The closing of their $12.7 billion all-stock acquisition of Comerica on February 1st means this Q1 report only captures, what, 2 months of Comerica's actual yield generation?
Months, yeah. But it forces Fifth Third to swallow 100% of the day one integration costs and provisioning upfront. The scale of that day one hit is really what completely derailed the headline EPS.
Oh, totally.
I mean, the gap between 15 cents reported and 83 cents adjusted, that is a net negative 68 cent per share impact.
Which is massive.
It's huge. You have a $657 million pre-tax merger-related charge just dragging down the bottom line.
And then on top of those operational merger costs, you have an $83 million pre-tax provision expense taken in the quarter.
Right, and that was just to build the day one allowance for credit losses, specifically for the Comerica portfolio.
Yeah, but that $83 million provision is just the income statement impact for the quarter. The total day one ACL they were forced to establish against the Comerica book was a staggering $744 million.
Wow, $744 million.
Yeah, most of that was pulled through purchase accounting. But the mechanical reality of CECL, current expected credit losses, dictates this massive upfront capital penalty.
Right.
When you acquire a $51 billion loan portfolio, you are forced to estimate lifetime losses and build that reserve immediately.
Even if every single acquired loan is currently performing flawlessly.
Exactly. Every single one could be perfect, but
Yeah.
you still have to build the reserve.
I always argue that CECL creates this temporary mirage in M&A quarters. It's like buying a massive new house.
Oh, that's a good way to look at it.
Right. Like on day one, your bank account takes this agonizing hit from closing costs, moving trucks, setting aside a massive escrow for immediate repairs.
Your net worth that month looks terrible.
It looks catastrophic. But your long-term earning power hasn't dropped at all. Fifth Third just absorbed $86 billion in total assets.
Which includes $65 billion in deposits, by the way.
Right. And the GAAP earnings just punish them for it in the near term.
What's fascinating here, though, is how the market is interpreting that upfront penalty. A $744 million ACL build on a $51 billion acquired loan book represents roughly a 1.45% reserve ratio.
Okay.
In the current macro environment, that is a highly conservative shock absorber.
Yeah.
Once you isolate that one-time reset, the sequential transformation of the balance sheet becomes the actual story.
Yeah.
Because you don't organically jump net interest income by 26% to $1.939 billion in a single quarter without fundamentally restructuring your earning asset base.
Well, I do have to push back on the quality of that margin expansion, though.
Okay, lay on me.
I mean, generating raw NII volume by just bolting on $51 billion in loans is straightforward math. You buy the loans, you get the volume. But the efficiency metrics are what stand out as highly contradictory to me. Their net interest margin expanded 17 basis points sequentially to 3.3%.
Right.
But the presentation explicitly cites that market rates were actually acting as a headwind on their floating rate commercial loans. So if the rate curve is pressuring asset yields downward, hitting a 3.3% in NEAM post-merger requires some heroic liability management.
It does.
How are they expanding margins so much while fighting gravity on the asset side?
Well, they executed an incredibly disciplined downward management of funding costs. While their earning asset yields were taking a hit from those market rates, they aggressively slashed the rate paid on interest-bearing liabilities.
So they dropped the costs.
Yeah, they dropped it by 16 basis points sequentially. They basically defended the margin from the bottom up rather than the top down.
But lowering your deposit costs by 16 basis points in this kind of rate environment usually means you are bleeding deposits.
Oh, absolutely.
You lose them to money market funds or high-yield competitors. But they didn't bleed out. The sources show they actually improved their deposit mix.
They did.
Demand deposits rose from 25% to 28% of their total deposit base.
And that is the Comerica synergy manifesting immediately. Comerica's historical strength has always been middle market commercial banking,
Right.
which comes heavily weighted with operating accounts and treasury management relationships.
And those are the sticky, non-interest-bearing demand deposits.
Exactly. By injecting that specific deposit profile into the balance sheet, Fifth Third drastically diluted their overall cost of funds. And that acts as a massive structural tailwind for Minim.
We also need to factor in the purchase accounting accretion, too, because the sources note that accretion chipped in a helpful $38 million to the NII this quarter.
Right.
And I know market purists often discount accretion as, phantom or low-quality earnings because it's really just the mechanical bleed back of the initial fair value discount taken on the acquired loans.
Yeah, some analysts just strip it out entirely.
So does that $38 million artificially inflate the 3.30% INM? Are we looking at a mirage?
I mean, it's non-core, certainly, but cash is cash.
Yeah.
The discount accretes into interest income over the life of the loans, so it provides a reliable, multi-year mechanical boost to the margin.
Kind of subsidizing the margin while they work on everything else.
Exactly. It subsidizes the margin while they work on actual operational cross-selling. But look, if you want a metric that ignores the accounting noise entirely, you just need to look at their tangible book value per share.
Oh, the TBV.
Yeah. It grew 15% year over year.
That 15% TBV growth might be the most aggressive data point in the entire release.
It's wild.
Because usually when a regional bank issues $12.7 billion in stock to execute a mega merger, the immediate dilution just crushes tangible book value for at least 4 to 6 quarters.
Oh, easily. It takes a long time to dig out of that hole.
Right. So to print 15% year-over-year TBV growth while simultaneously digesting all those day one M&A marks, it signals that the underlying retained earnings engine is just completely outpacing the dilution effect.
It also signals extreme discipline in credit underwriting. M&A execution typically fails when management's attention gets diverted by credit blowups in the legacy portfolio.
Right. You take your eye off the ball.
Yeah, you cannot seamlessly integrate core operating systems if your risk team is suddenly busy working out bad debt.
Makes sense.
But Fifth Third reported net charge-offs of just 37 basis points.
Which is incredibly low.
It's a pristine number. It marks their lowest loss rate since Q4 of 2023.
Here is where it gets really interesting for me, though. The presentation attributes that 37 basis point charge-off rate to, quote, intentional selectivity, including limited exposure to private credit.
Yeah, they are deliberately avoiding it.
I look at that and wonder if they are sacrificing long-term market share just for short-term optics. I mean, private credit is dominating the middle market lending space right now, and it carries massive yield premiums.
It does.
By intentionally capping their exposure there to protect their credit metrics, aren't they leaving a tremendous amount of yield on the table? Like, are they playing it too safe while private equity rivals basically eat their lunch?
Well, if we connect this to the bigger picture, the opportunity cost of passing on those private credit yields is negligible compared to the existential risk of a busted merger.
Okay, that's a fair point.
Their strategic hierarchy, as explicitly stated by CEO Tim Spence, is stability, profitability, and growth in that exact order.
Stability first.
Always. When you are integrating a $12.7 billion target, stability is a non-negotiable prerequisite.
Right.
A sudden spike in non-performing assets from a high beta private credit book would immediately compromise their 10.0% CET1 ratio and just panic the market.
True, and that 10.0% CET1 ratio is strong, but it's not bulletproof.
No, it's not.
Sitting exactly at 10.0% post-close means they have successfully absorbed the initial capital hit, but it doesn't leave them with a massive war chest for subsequent aggressive risk-taking.
Not at all.
They need that solid 28% demand deposit foundation and that pristine 37 BP's charge-off rate to defend the capital buffer while the Comerica integration matures.
Precisely. And that stability is really being anchored by their legacy retail operation, too, not just the newly acquired commercial book.
Right, the consumer side.
Yeah. Legacy consumer household growth hit 3%, which was driven by an impressive 8% surge in the Southeast.
Wow, 8%.
Yeah, and furthermore, they captured $2.7 billion in year-over-year new line deposits. So they are operating from a heavily fortified position, which is exactly what allows them to issue such aggressive forward guidance.
Let's transition to that Q2 guidance, actually, because this is where management is demanding Wall Street's attention.
They really are.
They are projecting Q2 net interest income to step up significantly, landing between $2.2 and $2.25 billion. That is a massive acceleration from the $1.94 billion they just printed.
It's a huge jump.
And they are also guiding for non-interest income between $1.00 and $1.06 billion.
You have to keep in mind, Q2 will be the first quarter reflecting a full 3 months of the combined balance sheet.
Right, without all the noise.
Exactly, without the day one acquisition charges dragging down the headline metrics. But that guidance relies entirely on their ability to execute the actual operational integration.
Yeah, the real world stuff.
Because you can merge the balance sheets on paper over a weekend, but the human capital takes years to graft.
Oh, I use that exact analogy all the time. Numbers on a spreadsheet are easy, but integrating a giant rival means dealing with human beings.
Yeah.
It is exactly like grafting a branch onto a tree. You can physically tape the systems together, but you have to wait to see if the human tissue actually connects.
That's spot on.
Because if the cultures reject each other, the branch dies. In middle market commercial banking and wealth management, clients do not have loyalty to a corporate logo.
No, they don't care about the logo.
Their loyalty is inextricably tied to their specific relationship manager.
And the presentation highlights that management is highly aware of this flight risk. They specifically emphasize the successful retention of key customer-facing colleagues from Comerica.
Which is crucial.
If Fifth Third had aggressively slashed those relationship managers to extract fast expense synergies, that $65 billion in acquired deposits would immediately walk across the street to a competitor.
In a heartbeat.
Securing that talent pool is the absolute linchpin of making this whole graft take hold successfully.
And we are already seeing the revenue synergies materialize from retaining that talent.
We are.
Spence noted early momentum across commercial and consumer lines. We are talking about legacy commercial clients being successfully cross-sold into Fifth Third's treasury management platforms, and vice versa. That cross-pollination is exactly what proves the combined entity is generating intrinsic value beyond just, mashing two balance sheets together.
Yeah, but honestly, the most striking strategic pivot hidden in this entire report isn't a digital synergy or a cross-sell metric.
Oh, what is it?
It's a massive geographic land grab. The sources reveal Fifth Third has executed or is in process on letters of intent for 81 branch locations in Texas.
Okay, wait. 81 new commercial leases in a single market is a staggering capital commitment for 2026.
It really is.
I mean, branch banking is notoriously expensive overhead. Why deploy that much capital into physical brick and mortar when the industry has spent the last 5 years obsessing over digital deposit acquisition? It seems backward.
It seems that way, but you don't acquire high net worth wealth management clients or complex middle market C&I relationships through a mobile app.
Okay, fair. You need the handshakes.
Right. Comerica already provided a deep, established beachhead in Texas for them. Fifth Third is using those acquired commercial relationships as a wedge to rapidly scale a localized retail and wealth footprint.
I see.
Those 81 physical branches act as highly visible billboards and advisory centers in one of the highest growth GDP markets in the country. They are weaponizing Comerica's historical geography.
It's an incredibly aggressive pivot. They are taking the localized stability of a traditional Midwest footprint, Cincinnati, Ohio, legacy roots, and they are utilizing a massive M&A event to catapult themselves into the Sun Belt and Texas.
Yeah.
It forces you to completely reevaluate the scale and scope of their operational blueprint.
This actually raises an important question for you to mull over as a listener and an investor tracking this space.
Yeah.
Fifth Third is now sitting on well over $260 billion in assets.
Right.
They're posting 8% household growth in the Southeast and committing to an 81 branch expansion in Texas.
Right.
So at what point does a traditional Midwestern regional bank simply stop being regional?
That is the big question.
Does the successful integration of Comerica fundamentally break the legacy categorization of Fifth Third, transforming them into a de facto national powerhouse?
It's the critical question, and it's one their immediate competitors in the top 15 bank rankings are undoubtedly stress testing right now as they watch this Q2 guidance unfold.
Absolutely.
Well, that is a wrap for our deep dive into Fifth Third's Q1 2026 earnings. Make sure you hit follow on the show for our daily earnings coverage. Keep digging into your own sources, and always remember to look past the day one M&A accounting noise to find the actual run rate. We'll catch you on the next deep dive.